Debt capital market. Exploring definition, types, and role. Presentation overview. Definition of debt capital market. Debt capital market is a market where debt securities are traded by companies, institutions, and governments to raise funds for their operations or projects. Types of debt securities. Debt securities traded in debt capital markets include bonds, notes, commercial paper, and certificates of deposit. Public and private markets. Debt capital market is divided into two main types, public and private markets. The public market is open to the general public, while the private market is limited to qualified investors. Role of debt capital market. Debt capital market plays a critical role in the economy by providing companies, institutions, and governments with a means to raise capital for their operations and projects, stimulating economic growth and development. Definition of debt capital market. Debt securities. Debt securities are financial instruments that are issued by companies and governments. They include bonds, notes, and other fixed income securities. Issuers. The issuers in debt capital markets are companies and governments that need to raise capital by issuing debt securities. They can be corporations, municipalities, or government agencies. Investors. The investors in the debt capital markets are individuals, institutions, and other entities that purchase debt securities issued by companies and governments. They can be banks, pension funds, insurance companies, and retail investors. Types of debt securities. Bonds. Bonds are debt securities that are issued by companies or governments and offer fixed interest rates and a maturity date. They are considered a relatively safer investment than stocks and are widely traded in the debt capital market. Notes. Notes are short-term debt securities, usually with a maturity period of up to 10 years. They're generally issued by companies and are similar to bonds, but with a shorter maturity period. Bills. Bills are short-term debt securities that are issued by governments and have a maturity period of less than 1 year. They are generally considered a low-risk investment and are widely traded in the debt capital market. Issuers and investors. Issuers. Issuers in the debt capital market are governments and corporations that need to raise capital. They issue bonds and other debt securities to raise funds for various purposes, such as financing new projects, refinancing existing debt, or funding ongoing operations. Investors. Investors in the debt capital market are typically institutional investors, such as pension funds, insurance companies, and mutual funds. They invest in debt securities issued by governments and corporations to earn a return on their investment and diversify their portfolios. Types of debt capital market. Public debt capital market. Public debt capital market is where debt securities are traded on exchanges such as New York Stock Exchange or NASDAQ and can be bought and sold by anyone. This market is generally more liquid than private market and offers greater transparency. Private debt capital market. Private debt capital market is where debt securities are traded between institutional investors and issuers directly without going through an exchange. This market is less liquid than the public market and offers less transparency. Public debt market. Liquidity. The public debt capital market is more liquid than the private market, allowing investors to buy and sell securities more easily, reducing the risk of losses or missed investment opportunities. Transparency. The public debt capital market is more transparent than the private market, providing greater access to information about the issuers and their financial situation, allowing investors to make more informed investment decisions. Access to investors. The public debt capital market provides greater access to a wider range of investors, including institutional and individual investors, allowing issuers to raise larger amounts of capital at lower costs. Private debt markets. Advantages of the private debt capital market. The private debt capital market offers more flexibility and customization than the public market, allowing for more tailored transactions and structures that meet specific needs. Disadvantages of the private debt capital market. The private debt capital market is less liquid and more opaque than the public market, which can make it difficult to value assets and assess capital when needed. The role of debt capital markets. Advantages of debt capital market. The debt capital market offers many advantages, such as providing a platform for companies and governments to raise capital to fund their operations and investments, diversifying risk and managing interest rate risk. Disadvantages of debt capital market. The debt capital market also has disadvantages, such as the potential for default and the risk of interest rates rising, which can increase the cost of borrowing and negatively impact investors. Advantages of debt capital markets. Diversified funding sources. Debt capital market enables issuers to diversify their funding sources, reducing their reliance on traditional bank lending and providing access to a wider investor base. Risk management. Debt securities can be tailored to suit the needs of both issuers and investors, providing greater flexibility in managing risk. Disadvantages of debt capital markets. Potential for default. The debt capital market carries the risk of default, which occurs when a borrower fails to repay their debt obligations. This can result in significant financial losses for investors. Interest rate risk. Debt capital market is subject to interest rate risk, which is the potential for changes in interest rates to impact the value of debt securities. Changes in interest rates can affect the demand for securities and lead to losses for investors. Economic factors. The debt capital markets can be impacted by changes in the economy, such as inflation and recession. This can cause the value of debt securities to fluctuate and result in financial losses for investors. Role of debt in the economy. Debt capital market. The debt capital market is a vital part of the economy, providing a way for companies and governments to raise capital to fund their investments and operations. Infrastructure projects. Debt securities can be used to finance a wide range of activities, such as infrastructure projects, which are essential for economic growth and development. Mergers and acquisitions. Debt securities can also be used to finance mergers and acquisitions, which are important for companies to grow and expand their business. Conclusion. Importance of debt capital market. Debt capital market is a critical part of the financial system, providing a platform for issuers to raise capital and investors to earn returns. It helps in the economic growth of a country. Advantages of debt capital market. Debt securities offer flexibility, liquidity, and risk management options. It allows companies and governments to borrow money at a lower interest rate. Disadvantages of debt capital markets. Debt securities have some disadvantages such as interest rate risk, credit risk, and inflation risk. It can also lead to over leveraging and increase in debt, which may affect the financial stability of the issuer. Thank you.